Hi everyone, and welcome to a new week in the U.S. markets. We had a down day, obviously, in some of the indices and some of the commodities we're going to talk about. But the more important thing is that we are seeing a little bit of a decoupling. You can see here on this chart that I have right in front of me, this is exactly what I'm talking about. I find this to be very interesting that we have the dollar obviously the biggest gainer today. But look at soybean meal, cocoa, sugar, coffee, live cattle, copper. These are the kinds of things that make me think that it's possible for some kind of decoupling. But let's get right over to gold. So it really didn't do very much today, the gold futures. In fact, if you recall last week, we kind of stopped at that 2028 level, 2029, and we did it again today. In fact, today's low was 2030. So we're holding not only that, but after one test of the 50-day moving average, we're still above it. So that kind of makes it pretty clear. Once again, there's your pivotal area, 2030 down to 2028. Above, we have to be more positive. Below, maybe slightly more negative. Of course, then we would be looking clearly at 2022 to down to 2020, which is where the 50-day moving average is, which I might add still has a positive slope. So even any kind of penetration of that move below it would not necessarily be sustained unless, of course, it goes on for a while. And how would we know? Well, a couple of things is one is we would get a close underneath this low on this day, which is 2017. That might give me somewhat of a clue that things are not necessarily as strong in the universe of gold as we would like to believe that it will be over time. So keep an eye on 2017, 2022, 2028, and now if we do get back over and hold above that 2030 level, and by the way, today's closing level in gold was 2030, so that is super pivotal. Then the next place we really have to look is up here at around that 2050. I mean, we could see a little bit of movement between 2030, 2040, but 2050 is going to be the next key. And of course, I'm still going to maintain we get over that 2050, 2055, up she goes, because I still really like it overall in a bullish formation, because at this point we're just ranging. Now, of course, the momentum has a little bit more negative things to say, and that's why I wanted to show you this. After the mean reversion, we had the down move underneath the 50-day moving average with the 50 underneath the 200. So this is a bearish formation here in momentum, a bullish price chart. But also after we had that one nice little pop last week back above the 50, we're back below it. So the momentum is telling us definitely not to get over exuberant from the long side. Be cautious at the very best, and again, if it breaks down under those levels, maybe we can expect to see more of a flush. And where would that be? I would guess somewhere around 1980. Now we're looking at oil. Of course, this is WTI oil. This is the February contract. And so far, again, shenanigans. One day above the 50, 2 days below, one day above, back below. So when you get this kind of movement around a moving average, up and down, up and down, up and down, and the slope of the moving average in this case is probably more neutral, maybe slightly positive, you know something's coming. So we have to be prepared for both. We also still have that series of higher lows, so that's the optimistic thing. But meanwhile, obviously, we always have to keep an eye on this most recent low at $68 a barrel. But for tomorrow, considering everything that we've had heated up with the Middle East and the Red Sea, not much has happened. So I'm looking right now back at around 72, which is the top of the body of this candle where oil opened today. 72.66 is our first pivotal area in that. That would be above the 50, that would be above the opening price, and that most likely would give us at least some kind of an initial rally. This has really been having trouble getting pretty much past these levels right here at 73.55. So between 72.66 and 73.55, that's where I'd like to see it go. And of course, if we can clear there and get a close over 74, that's probably a really good thing. But we also equally have to be prepared. But what happens if we can't get through that 72.66? We come in under the 50-day moving average at 72.33. We can't get a rally. And now we start to sell off. Our closing level here in crude oil today was at 71.79. So we're still even a far away right here from the 50-day moving average at 72.34. So between 71.79 and 72.34, there could be some chop and some kind of decision making that has to be made. And of course, if we can't get back through that 72.34, we know it's most likely down. And obviously, if we break 71.79, then we would be looking at today's low, which today's low was even lower still. That was at 71.23. And then, of course, here we have some kind of support here at 71. So between 71 and 71, where we closed today, as I mentioned to you before, 71.23. If we open there, I would take that as a sign of weakness. We break 71, we definitely look weaker. And if we hold 71, hold 71.33, get back through the opening, which was around 71.65, and then of course 72.34, then we can start looking for some kind of a move to the upside. Let's move to natural gas. I love really showing these charts here from TradingView because we get to see the momentum indicators and they're so important. So of course we anticipated the move over 3. We never got over 340. Then as we started to get into obviously Monday and Tuesday, even though it was closed in the US, we saw the down move. And that's because there's been news now that the worst of the freeze in Europe potentially has passed. We don't know. The point is that this wasn't a very large sustained rally, but nor has it been the break of, oh my God, that's it, we're going back down to the lows. So what do we have to see? Well, here is your 50-day moving average here at 280. So I'd say that 280 level, if we want to bring it down a little bit more, 279 to 280, major support. We hold that. And today's low, of course, being 285. We hold anywhere between 278, 279, and 285. That probably means that maybe this was overdone a little bit, and then we'd have to look at 290. Of course, $3 is really still my big breaking point. If we break down under that 280, that means that we probably are going to see another test here at much lower levels at around 270 and possibly even down to this 269, which is the 200-day moving average. So that's kind of goes right now. If we step back a little bit and look at the overall formation, we could be doing a lot of work here. If this is going to be any kind of a bottoming here, which it can be, it spent a reasonable amount of time down there, and even before that, if we go back in time, we definitely have done a lot of work down at these lower levels above 2. But if we stay in any kind of a bullish scenario in natural gas, we could see some chop here between, let's say, these recent highs, or even say between 323 and 280, and chop around, forming maybe some kind of a quasi right shoulder to this one. Too premature to say. I'm still not all that interested in trading this at this point. Plus, let's go to momentum. Here's that classic mean reversion I explained to you last week, where it gets above the Bollinger Band and then breaks below it. And we're not seeing any kind of divergence here in momentum and price. This is sitting right on the 50. This is just above it. And of course, the 50 is above the 200. So we're still in a bullish phase here in terms of the momentum indicators, and a slightly, although weak, bullish phase here in terms of price. Staying consistent with these charts, this is SPX. And so let's go start here with the momentum indicators. We had that mean reversion, which of course turned out to be the high for a few days. We've gone back to try to test it, even made a new high on this one. And now this is interesting right here because the high this day was 4,802. So we kind of tried to clear that 4,800 and we couldn't maintain it. And then, of course, today's closing prices were 4,765. But if we go down here, we can see that the momentum is declining. But is it serious yet? Not necessarily. We need to see a little bit more of a decline in momentum before we get too bearish, and that means that we're not all that bearish yet in the price either. This was just sort of some kind of a correction. However, we do like to talk about reversals, and on the closing price here at 47.65 and the low here, which was 47.68, we did officially close above a new, not only 60-plus day high, but obviously a multi-year high, which could mean now that this is the start of a bigger correction. So how will we know? Number one is we should not at least close back above 4,768. So let's call that our pivotal level. If we look at the day, we kind of had a narrow range between the open and the close. So we're looking at 4,768 up to 4,772. We stay above there, I would say that this was just sort of a one-day kind of a thing, and we'll see the momentum come back. We can't get back above that 4,768, and we break down under the 4,765. Then I think we're going to be looking a little bit weaker here, and possibly our next level would be where this doji day is, and the body of a candle is this day, which would be 4,741. And then, of course, if that holds, we would be back to looking at that 47.65. If it breaks, then we'd be going down to the next level, which would probably be closer to 4,725. The main thing is that, yes, keep an eye on the negative momentum, but at the same token, also keep your eye on the price, because I'm not seeing anything in terms of the divergence like we just saw in some of the other charts, particularly in gold. And if you have any doubt about mean reversions and how interesting they can be, we talked about the mean reversion last week when we looked at the pair of the dollar versus the yen, obviously the dollar being the lead indicator. It had a strong day. It actually had probably one of the biggest leads on the board, especially as we're looking at futures. And so it held that Bollinger Band, and now look where it is. It's right below the 50-day moving average, which, by the way, is also in a bearish phase. The 50 is below the 200. That means momentum is bearish, and we rallied right up to the resistance of momentum, while the price is bullish, and we actually got through the 50-day moving average in terms of the actual price itself, but right into some resistance. So that's kind of make it pretty clear. This may gain in momentum, and we can see this thing have a nice pop, but otherwise what we're going to be looking at is this congestion right here as pretty good resistance all the way up to the dollar versus the yen, 147.46. That would be the level. If we get through there, then obviously it looks like the momentum is improving and the dollar could get stronger against the yen. And then on the other side of it, if we look at the same level of congestion where it broke down, would be 146.57. So under 146.57, it would seem to me inevitable that the first test, of course, would be 146.12, which is where your 50 is. And also, if you look at where that finger pointing is, those couple of highs on those bodies of candles that go back to December, we get under 146.12, then I think this was a failed rally, and we'll start to see the dollar turn down, and then we can prove that this momentum was nothing more than a short covering rally, mean reversion trade into resistance, and this was a false breakout over the 50, and down we go. So that's kind of how we are looking at things right now. So again, I forgot to announce myself. This is Mish Schneider, Chief Strategist of MarketGauge.com. Hope that was helpful. See you again real soon. Bye for now.